welcome. This is Hard Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks which are buzzing in trade. I am Agam Vakil. And on that note, let's get in our experts for today. We have independent investment advisors Vivek, Mavani and Sharmila Joshi, along with Lancelot Cunha of ValueX, who are joining us on the show. Thank you all for joining us and taking us through your views. Today on the show, we discuss Kotak Mahindra Bank, which has seen healthy returns over the last 3 months. We discuss what is aiding investor interest in that stock. We also talk about CSB Bank, which saw a very, very strong listing on the bourses, and what are the prospects going ahead. ICICI Securities, which has had a stellar run as well this year. The stock is up as much as 60% in the last 3 months, and we discuss whether or not this rally will continue in the counter. And lastly, we have Polycab, which is also in focus on the prospects for the company, considering the kind of gains that we've seen already. Now, it's true that at least the quality out there certainly has been looking up. But speaking of quality, let's start by taking this decision on as far as Kotak Mahindra Bank is concerned. It's one of those silent counters that continues to move up, and for this part, it's in this case, it has been no exception. So currently at around 1670. Sure, it's declining today, but it has seen a lot of strength of late. Let's open up this discussion with Vivek. Vivek, how are you seeing Kotak Mahindra Bank pan out? What's the way forward here?
Well, there are, to my sense, 3 things playing in favor of Kotak Bank in terms of the handsome gains that it has seen in the recently. And you rightly said, it's a silent performer. Doesn't make too much of noise in that sense, but has quarter after quarter performed and delivered upwards of 20% earnings growth with very strong balance sheet and discipline in terms of capital control on NPAs and so on and so forth. But what is playing on the stock, having rallied sharply upwards of 30% in the current year itself? 3 things. While the banking and financial sector has seen a lot of casualties and a lot of unraveling of balance sheet and corporate governance issues with large number of other entities, and your opening remarks, as you mentioned, I mean, the shift towards quality, so Kotak Mahindra Bank is obviously a beneficiary of that. Corollary to that is, as far as the fund houses are concerned, whether we are talking of mutual funds, whether we are talking of FIIs or ETFs or whatever, they generally tend to have a certain allocation sectorally, which they maintain the sectoral allocation. Within that, maybe stocks could rotate. So while the overall BFS banking and financial services allocation in their portfolios would have remained, maybe the lower allocation to maybe a Yes Bank or some of the NBFCs that they would have either reduced or exited, obviously would shift to some other bank or a financial services outfit, and Kotak is a beneficiary of that. Not to say that Axis and ICICI also beneficiaries of the same, because in terms of their balance sheet issues got repaired maybe about 12 to 18 months ago, and now they are going strong. The other reason for Kotak, which is more of you could say herd on street, or more like market participants trying to forcefully put an argument to it, which is a believable argument, not to say that it's a fake argument, is that there is inherent value in the subsidiaries in terms of Kotak Securities, in terms of the life insurance business, in terms of the general insurance business. There's a ARC business, all of which are subsidiaries of Kotak Mahindra Bank. Right. And what we have seen in HDFC, SBI, ICICI, which all of whom in the last 2-3 years have value unlocked the subsidiary values by way of IPOs and then subsequently offer for sale, etc. Right. So there is a hope and expectation that Kotak will also eventually do that at some point of time. Not that Kotak really needs money. So neither the bank nor do the subsidiaries, I mean, all of them are well capitalized. So they really have no compulsion to go out and raise money, nor the only regulatory overhang is that Mr. Uday Kotak needs to reduce his shareholding from upwards of 30% and bring it down to 20%. That's the only overhang. Otherwise, a fantastic bank, consistent performance quarter after quarter, year after year. On the valuations at about maybe 4.5 times price to book, little premium to HDFC. But that little premium is, as we mentioned, about there is a substantial subsidiary value, which in HDFC, barring their NBFC subsidiary, there is no other I would say inherent value, because all other HDFC subsidiaries are actually subsidiaries of HDFC Limited.
Right.
So
Okay.
I'm positive on that disclaimer that already have a holding at personal level as well as on behalf of clients.
Okay, fair enough. Well, so that's Kotak Mahindra Bank for you, and that's Vivek's view. Sharmila, of course, all valid points, but valuations stick out for you.
Yes, absolutely. I think extremely high valuation. And I think two more points that I'd like to make here. One is, I think, of course, what Vivek was alluding to. I think that you can't escape from the fact that the promoter ownership is going to be an overhang. So I think exactly about a year back, we heard like a lot of big names were talked about in the market that XYZ is going to buy stake and so on and so forth. And the stock started moving up, and nothing has really come forward out of that. And this is an ongoing issue, which at some point would have to get sorted. I think what could sort of aiding them in this at this point in time is that we have the Yes Bank decision which is due tomorrow. And RBI's stated position on this has been, of course, that they don't want any single any single party to hold such. Now, if for any reason they allow Yes Bank through, and Yes Bank needs the money now, then maybe Kotak Bank's their stand becomes stronger. Because they'll say, if you could allow that guy, why not us? And maybe market is reading more into it than what we can see at this point in time. So that could be possibly one reason. And I think the second reason is again what you referred to, that these banks, these couple of banks, whether it's HDFC Bank, ICICI Bank, Kotak Bank, they are better placed than even some of the other private banks. We were just discussing RBL a little while earlier, or a Yes Bank. So they are definitely better placed than them because their skeletons are not as big and as obvious. Though very honestly, even in all these three names, the stress of retail lenders has shown in the books. But they have not dodged the bigger bullets so far. So from that point of view, they're safe. So it's a good bank, but I really wouldn't buy it at this price.
Okay, so Lancelot, two opposing views, not necessarily opposing. I'm sure that they agree on a lot of factors, but there's valuation as against what Kotak Mahindra Bank offers. Where do you stand here in this picture?
I think valuations are expensive, because what has happened is that you have to look at this market for a period of time and understand that it is not only in the banking space, but wherever there has been good earnings growth and wherever there is a sense that this bank or this institution is going to sustain, there is a flight towards security. So people are moving out of companies or banks where there seems to be an issue of concern and moving into these stronger companies. The question is not about valuation, but it's more about parking money into something that is safe. And I think that fear over a period of time, as the economy sort of turns around and as the banking and financial system begins to stabilize, that fear will again start to moderate. So actually that is what has been driving it. So I don't know whether, at this point of time, it's definitely something that is expensive, so one should wait, and whenever this moderates, you could see an opportunity to buy as well. Okay,
so Lancelot, right now, what my question then is that markets are near lifetime highs. We just hit a high recently. There's always a possibility that a retail investor may think that now markets may come off. Why don't I just park my funds in something relatively safer? In that case, why not Kotak Mahindra Bank?
Well, from an equity perspective, if you look at equity, definitely everybody is moving money into equities because the interest rates are lower and the returns are much lower. So yes, the flow of money into these few top stocks is going to drive the prices up. But it's not necessarily that it would sustain at those levels. And whenever the flow begins to reverse, you would also see a sell-off happen at that point in time.
All right, fair enough. So some very, very valid points coming in from our experts on Kotak Mahindra Bank. And perhaps the only question in this case is the valuations, nothing else. And everything else is going in favor of Kotak Mahindra Bank, including the fundamentals, which are very much in place for now. But from there onwards, let's talk about, we stick to the sector, but we'll talk about a new entrant here. And that's CSB Bank. We know that it's had a very, very strong listing just a few days ago. It's currently at around 271, and if I'm not mistaken, it was issued at around 175 rupees per share, if I remember that correctly. That said, it's IPO season, so to speak, and almost all the IPOs are getting a roaring response. So, Sharmila, I'll start with you. Where do you stand here on CSB Bank?
So, well, very honestly, I'm not a big fan, of this kind of an issue because, to my mind, when you have this kind of a issue, you're sort of really providing an exit to some existing shareholders.
Absolutely, yes.
So, yes, I think some amount of money is going towards the bank in helping them strengthen their book, etc. But it's actually provided an exit for their older investors. So, I'm personally not in favor of such issues. But yes, we saw the kind of subscription that the bank got, the IPO got, and we saw the kind of opening it did. So I think it puts to mind two things. One is I think that all the positives are now in the price.
Right.
Because I think, the book that we've seen, the kind of, they've in fact had a loss from FY17 to 19.
Yeah,
so, okay, now you can expect that now that this money is come in, their book will grow stronger and from here on things will get better. But as I said, at this price after the bumper listing that they had, I think all the positives are in the price. So you hold what you have if you are lucky enough to get anything in the IPO, but I wouldn't really buy anything fresh.
All right. How about you, Lancelot?
Yeah, I would also tend to agree that this is really what has happened.
Yeah.
So while the bank is good, there has been restructuring over the last 2-3 years that is playing out. But if you compare it, with other similar banks, similar sized banks which are already listed, they are trading at a fairly high premium to those banks. So there's no real big case to say that the valuation is attractive and one should buy at this point in time. One may look at just waiting it out, and if you're already holding, just hang on to your investment, see where it goes, and then probably you can book some profits as well.
Okay. All right, just curious, would you guys have subscribed to it even at, say if it was actually trading at its issue price, would you guys have been into it?
As in, meaning if I would have bought it if it listed
at issue price?
Probably I would avoid it even then.
Even then?
Yeah.
Do you agree with that?
Yeah.
All right, Vivek, where do you stand in CSB Bank?
Well, I'm extremely negative, in that sense, because if I look at the numbers, as Sharmila mentioned, that until 2019 it was a loss-making bank, so there's no point of talking about book value and return on equity and typical stuff that we talk about as for banks and financial institutions. They turned profitable only in the first half, that is only 2 quarters of profitability, number one. But if I look at all the other operating matrices, return on assets, just about 0.5%. Cost to income ratio 58%. By the way, that 58% is higher than some of the PSU banks as well. So even if I were to compare it to Bank of Baroda, which has or even a State Bank of India, the cost to income ratio, in spite of all the legacy and trade unions and all of that, they have a cost to income ratio in the vicinity of 45 to 50%. So this is higher than some of the PSU banks as well. NPAs close to 3%, upwards of 2%, net NPAs 1.5% whereabouts. But if we look at the book value adjusted for NPAs, maybe about 1,300 crores of book value, market cap of 4,800 crores. So we are talking of 3.5, 3.7 price to book for a bank, which I would be charitable to say that it has got a very mediocre performance. Actually, it's got a very poor performance even after Prem Vatsa got in about 2 years ago.
Sure.
So Prem Vatsa put in capital that time. There's been a little more addition to capital post the IPO, and there is only a hope that the performance of the bank will improve. Now, if I have to, or if anybody were to invest on hope, then there are probably 500 other stocks where you can hope for a better performance, better balance sheet, better operating matrices, and sit on hope. I'm not really a fan of that kind. And if I have to have hope, then at least I'll buy something with much lower valuations. Then why not an RBL Bank at 1.5 times price to book? Not that RBL Bank has also got doesn't have issues, but they have just last week or in the last 2 weeks raised a QIP and a preferential raise, say a substantial capital. Equity dilution of almost 17-18%, which is quite a sharp dilution. They have just raised capital, so even they have got capital to sustain a high growth. Or maybe or maybe it's an IDFC Bank, just to take another example. Although I don't really see a case for getting into tier 2, tier 3 private banks in the first place. When you're tier 1 banks, the likes of Kotak that we just discussed, or ICICI or an Axis, if they are going to deliver upwards of 20% earnings growth without too many issues, then why even venture into these tier 2, tier 3 banks with with nothing impressive to talk about in terms of operating matrices? So to answer your question, would I be a buyer? Certainly not at 270. Would I have been a buyer in the IPO? Well, not really even at the IPO, because for me, one of the key things is, a business has to be profitable, and CSB doesn't really give that confidence.
Okay, well, some good points being put out, but there is a consensus here that all our experts are of the opinion that they'd want to stay away from CSB Bank. Not only would they subscribe or perhaps enter at these levels, but they probably wouldn't like this bank even or at the issue price of around 170, 175. And well, there are many other prospects out there. Well, for at this point in time, we are looking at CSB Bank at 270. Can we expect some volatility weakness? That's something that we're going to have to wait and watch out for. And from there onwards, let's talk about a sector and perhaps one stock which is standing out. That's the broking sector, and we have seen spurts in the likes of Motilal Oswal Securities, or for that matter, in this case, and the subject of our discussion, ICICI Securities, because we certainly have seen a lot of strength in this one. There have been a lot of gains, but it just so happens that the fortunes of a broking firm are very, very closely intact with how the markets tend to perform. So we have seen that up move around 61% on a 3-month basis. But Lancelot, again, how do you stand on the company, the prospects, the fundamentals, and perhaps the valuations?
See, the business is a very difficult business. We've seen it with various other broking firms as well. So you can't really give a high valuation. While there has been growth, you have the likes of the Zerodhas and all who have come in and really captured market share at a low price point. And that is going to put pressure on both margins as well as on the volume addition. So while an improving market may improve volumes for a while, it's very difficult for companies to sustain, and for which when valuations are high, it becomes even more risky. So from a risk reward perspective, it looks difficult to predict that maybe 1 or 2 negative quarters and you could see again a drop in price.
Okay.
And you must remember this particular stock IPO'd at 570 levels, and this is nearly 2 years back. So it's better to stay away at this point in time because valuations are high. I do feel that you'll see some correction coming.
Okay, can you throw some more light on Vivek and where you stand on this one?
Well, I'll agree with Lancelot. It's not only a difficult business, it is prone to a lot of disruption, which actually most of the market participants, and I would sense even the managements of companies itself may have it tough to grapple with. But two things. I mean, if I were to, I was just seeing over the weekend, the 52-week low was 180. Of course, the IPO price upwards of 500, 52-week low is 180, so it's almost done 100% from its 52-week lows, and then you'll try to compare it. The rally actually took strength with the listing of IFL Wealth, and it got when it was hived off from IFL Holding just a few months ago, and which is where ICICI Securities came into limelight suddenly. IFL Wealth valued at 12,000 crores market cap, and ICICI Securities was less than 5,000 crores at that point of time. So if we look at the valuation at the 52-week low from that point that the rally took off. So probably that's the reason why ICICI Securities has rallied in the last few months. That's the only sense I could have, because in terms of performance, nothing really in terms of uptick. So although your Nifty may give you optically 12,000, not that the trading volumes have improved or not that the fortunes of brokerage houses have improved. Right. That's number one. That's on the equity brokerage side. Equity brokerage business itself prone to disruption, as Lancelot mentioned, in terms of the likes of Zerodha and all that. The other is just competition, whereby we do come across ads and promotions of brokerage being flat per lot, 20 rupees per FNO transaction. Nothing to do with percentages. So we are so even the 5 basis points and 10 basis points may be history in terms of your trading volumes. The realization of brokerage vis-a-vis the trading volumes. That's number one. Now the second large business all of these guys have is the wealth management, which is nothing but distribution of financial products, mutual funds, insurance, PMSs, and so these companies are distribution powerhouses, and ICICI Securities is the largest with upwards of 2 million client accounts, retail plus HNI, and much of the and that's a very chunky business in terms of commissions that they make on distribution of financial products. The risk of disruption are two-pronged. One is commissions itself falling either by regulation. SEBI and IRDA both in the last few years have put a clamp down on the maximum commissions that can be paid. If we recollect, in 2010, SEBI did away with entry loads for mutual funds, which was nothing but indirect commissions being paid to brokers. IRDA also put a clamp down on maximum commissions that could be paid on new insurance policies. Now, Is that a trend which will go on? I think yes. SEBI and IRDA will continue to keep pushing commission rates lower, and competition also will force it to be lower.
Right.
Technology also will disrupt the business, which we don't know what would be the shape or how would this business shape up over the next 5 to 10 years.
Sure.
With all of these things, are the valuations attractive? I don't think so. Valuations don't factor in some of these risks. Even I don't know what are these risks. So let me also admit that, which is why I'm neutral on it.
Okay.
Volumes will grow. So if we were to talk of financialization of savings in this country, the likes of ICICI will obviously lead it. Right. Given the large network that they have on the ground, backed by an ICICI Bank, which itself has like upwards of 5,000 branches. But I wouldn't be buying the stock at 350, 360 now.
Okay, point taken. Very quickly, Sharmila, where do you stand here?
Yeah, I would broadly agree. I think that last quarter numbers were decent. So I think that is one point in favor of them. But I would broadly agree that I'm cautious on the sector for the reasons mentioned, that overall this is a business that is undergoing a change, and we've seen the signs of that ever since players like Zero Adda, etc. came in. So, that's the threat. And I think the other concern, which probably was lesser in ICICI Securities, which is why you have also seen a rally, is that this, at one time, all the broking businesses were being thought of very attractive because they had an ARC book.
Sure.
But now that's the exact book that has gone against the players who invested heavily into them. So possibly, which is why you saw some shift to ICICI Securities, given the fact that numbers were decent, the price was low, and they didn't have these concerns. But I would really be very wary of this sector and this, the entire sector, not just this stock as of now.
All right, fair enough. Well, guys, we're running out of time, so I'm going to take a very quick view on Polycab because, we have discussed quite a bit. But about Polycab again, it's seen a lot of strength of late. It's almost 1,000 rupees per share. Sharmila, coming back to you, what's your stand? If you could just give us a very quick take on this one.
Well, the numbers are certainly very strong, and this is a stock-specific market, and people are liking this FMEG space, as it's called, and they're seeing the good possibilities in the cable and wire business going ahead. So from that perspective, I think you could look at it if it were to come down from here, because as I said, the market is liking the stock at this point in time. Though I think valuation-wise, it is fair. It's not leaving too much on the table, which is why I'm saying buy it on dips. But yes, given the numbers, you could look at it on dips.
Okay, look at it on dips, Lancelot.
I would also agree. I think the valuations are expensive at this point in time.
Yeah.
And while everybody sees the opportunity in affordable housing, and there's a huge growth spurt that is happening there, so there is a lot of demand from for the wires, cables business.
Right.
But I think you need to wait for a while before you can buy it on dips and hold on to it, because any small disruptions can create because in these high volume stocks you could see them fall 10-15% easily whenever there is a large selling that happens.
Sure. All right, Vivek, in less than a minute, what's your take on this one?
Well, I'm again negative on Polycab, because if I were to firstly, in terms of consistency of growth track record, Polycab doesn't really have that level of consistency. Number one. Number two, in spite of being the largest cable and wires company, the business profile seems significantly inferior to a KEI, which is the second largest. KEI has got much better margin profile, return on capital, return on equity, cash flows, working capital, so on and so forth. Polycab doesn't have it for the cables and wires business. The other business of Polycab, the electrical goods, FMEG, fast moving electrical goods. If I were to compare it to an Orient or a Crompton or a Havells or a Bajaj Electrical, I mean, all of who have some sort of overlapping product. There again, it's significantly inferior, because all others have significantly higher return on capital, return on equity. All of them are debt-free, work on negative working capital. Polycab doesn't, which is very surprising.
Right.
So overall, I mean, Polycab for both the businesses, if I were to compare to some peer group, it's got an inferior margin profile, return on capital, return on equity, cash flows, and wonder of wonders, is valuation is higher than some of the other companies. So for me, a KEI is definitely is a preferred bet at just about 8 times EV by EBITDA, versus Polycab, which is about 13-14 times EV by EBITDA.
Okay.
Not to speak about Havells and Crompton and Orient. I'm not even talking of those, where although the valuations are higher, they earn much higher return on equities, which is upwards of 50%.
Right.
While Polycab struggles even with 15% return on equity on a sustainable basis.
Okay, fair enough. So valuations once again are an issue at this point in time, and at least two of our experts are suggesting that they'd buy it, but not at these levels. Maybe with some bit of a correction, they'd possibly consider getting into it. Well, we have run out of time on the show, so I'm going to take a moment to thank all our experts here for joining us and taking us through their views on the stocks discussed. And on that note, it's a wrap on today's edition of Hot Money. Ask BQ is up next. Stay tuned to BloombergQuint.